Good morning, everyone, and thank you for joining us for our monthly GrowFL webinar series. We are very appreciative of your time today and hope you will get a lot out of the webinar that we have planned for today. We'd like to thank our webinar sponsor for today, which is Withum Smith & Brown. Withum empowers clients with innovative tools and solutions to address their accounting, tax, and consulting needs, and their highly responsive team of professionals offers deep industry expertise and service experience to help their clients grow and thrive. And I wanted to start out today. My name is Tammy Sweet, and I am the director for GrowFL. And I wanted to start out today with just a little bit about GrowFL and our mission, which is to serve with second stage businesses with strategies, resources, and support to help you grow to the next level. And we have a number of programs that you can get involved in order to continue to grow your company. The first program is strategic research, and with that program, our experts will work with your sales and marketing team to help explore strategies and discover new resources to increase top-line revenue. Our job with strategic research is to help you to explore where you can find new customers and how to access those customers. We also have peer learning opportunities. We have CEO roundtables and CEO forums that are located throughout the state of Florida. CEO roundtables are monthly meetings, and they are held in all the major markets throughout the state of Florida. CEO forums are quarterly meetings where we bring in a seasoned entrepreneur to speak to our second stage CEOs about their success stories. We do have a CEO forum tonight in Orlando, and next week on June 20th, we have one in South Florida, so please check out our website for that information at growfl.com. In addition, we have other leadership development programs, including leader retreats, webinars such as this that we're holding today, which are usually done on a monthly basis, and we also do other workshops and events that help to bring resources and information to you as the CEO of your company as you're trying to grow your business. We also have a special program for our manufacturers here in the state of Florida as a partnership with Florida Makes. Florida Makes is our statewide resource for manufacturing services that help with both bottom line and top line services. GrowFL's program we have opening up will begin a new program announcement. We have our first class of CEO roundtables that are being done virtually for the manufacturing industry. We just started our first one this year, and we are looking to start another one in August. So if you're interested and you're a manufacturer to participate in a virtual roundtable, we have that available as well. And those meetings are 6 monthly meetings. They're 2-hour video conference calls, and they're with our partner, the Edward Lowe Foundation. Also, the application process is opened up for this year's Florida Companies to Watch Awards program. This is our annual awards program where we recognize 50 of the up-and-coming second-stage businesses throughout the state of Florida. This will be our 8th year, so we do have 350 companies that we have recognized over the last 7 years, and we would love to have an opportunity to have you apply and participate in that program. You can go to our website, growfl.com, and you can click on the Florida Companies to Watch link, and that'll take you to the information about how to apply and what the requirements are for application. So please check that out. The application deadline for that is July 9th. So please look at our programs. Check us out on the website, growfl.com, and see all the things that we have going on. We usually have multiple activities going on throughout the state in various markets. So look at an opportunity to get involved today. So again, our webinar sponsor today is Withum, and we're very excited to have an update here on this, the tax laws and being able to help you better understand how the Tax Cuts and Jobs Act is going to affect growth companies. And our speaker today is David Poillucci. He is a CPA with Withum. David has over 15 years of experience in public accounting, specializing in tax planning and compliance for C corporations, S corporations, and partnerships. He is an active member of the firm's tax services group and concentrates his efforts on providing incentives to clients such as the Research and Development Tax Credit and U.S. Export Tax Incentives. Additionally, David specializes in tax law research, tax audit representation, and working with multi-state middle market clients. He has industry expertise in manufacturing, financial services, and the restaurant and hospitality services. So please welcome David. Thank you.
Good morning, everyone. Thanks for participating in the webinar today. Tammy, thank you for the introduction. And Withum truly appreciates, its partnership with GrowFL and for the opportunity to present this morning to your members. So today we'll be discussing an overview of the Tax Cut and Job Act signed into law at the end of 2017. The focus primarily today will be on individual and business provisions. As Tammy indicated, that will be most relevant for growth stage companies. So with that, we'll get started and we'll take a look at the individual changes and then transition into the business changes. That's my contact information there in case you need to follow up with any questions after the webinar. Just one point in terms of questions. Feel free to use the chat box on the lower left-hand corner of your screen. I'd like to reserve, say, the last 10 minutes of the webinar today to address any questions and as not to interrupt the flow of the presentation. But we will try to get to all your questions at the end, and if not, I can follow up with you after the webinar. All right, so first on to, as I said, the individual tax changes. Here we're just going to cover some highlights. I'm not going to go into a great amount of detail on most of these individual provisions. But obviously, as everybody knows, and I'm sure if you read in the news headlines and seen in the media, lower tax rates for individuals. There's been an increase in the standard deduction, which I think is probably most impactful for no-income tax states like Florida. So there's a $12,000 standard deduction for individual taxpayers and $24,000 standard deduction for married taxpayers. But with that, there's an elimination of the personal exemptions, so what you get kind of gets taken away a little bit. There's also the elimination of miscellaneous itemized deductions, so unreimbursed employee business expenses, investment management fees that you pay, those are no longer deductible under the new law. There's a limitation on state and local tax deductions, again, not as impactful for Florida residents that don't pay any state income tax, but that will impact your real estate tax deduction. We'll get into a little more detail in a few slides on the home mortgage interest and equity interest limitations that have changed. There's an expanded child tax credit, also an increase in the AMT exemption and phase out. So all of these kind of combined and looked at together certainly do provide some favorable changes for individuals. The last two items there are limitations on excess business losses and NOLs. We're going to get into that into some detail. And then there's a new qualified business income deduction, which we'll also get into some detail, which I think you'll find it beneficial looking at growth companies and particularly ones that are in the earlier stages that may have losses and the impact there. And then to the extent you do have income, the qualified business income deduction will prove to be a nice benefit. Just want to note here, as you can see on the bottom of the slide, most all individual changes under the Tax Cut and Job Act do expire on 12/31/2025. Without any further legislative changes, as of 2026, we'll revert back to the pre-2018 tax law. So next I thought with respect to individual taxes, I walk everybody through just kind of winners and losers under the new tax law, help illustrate a couple of examples to see the impact pre-tax law, pre-TCJA change and post to see the impact on overall federal taxes. So the first assumption here, just 250,000 wage earner, 1,000 charitable contribution deduction, mortgage interest 10,000, real estate taxes 7,500, state income taxes 11,100 for married filing joint, and 13,300 under a single scenario. Again, these are New Jersey New Jersey income taxes. Just as an aside, I do reside and work in New Jersey. Withum does have an office down in Florida, but I do reside in New Jersey. So kind of compare and contrast the impact on my taxes to those of you who are residing in Florida. And then looking at married filing joint with 2 qualifying children. So if you look at the 2 tables below, you can see that a single taxpayer, the left table, bottom left corner, New Jersey resident, 2018 versus 2017, kind of neutral in terms of the impact on the overall taxes. And these are just federal taxes. Married filing joint, there's a $6,428,000 decrease in taxes over 17, and that's predominantly driven by the enhanced qualified child tax credit. Now, looking at Florida residents, you'll see that there's more of an impact on Florida residents, a single taxpayer realizing a savings of $1,743 under this example, and married filing joint realizing a tax savings of $8,350. And the reason that the Florida resident receives a bigger benefit here is based on the expansion of the tax brackets, which we'll see, and the increased standard deduction is helping you more than taxpayers in higher tax states. Take a look at another example, just increasing the metrics here, $500,000 in wages. You can see the other deductions, how we increase those. A single taxpayer here in New Jersey actually gets hurt. Married filing joint taxpayer, again with the enhanced child tax credit and the expansion of the brackets, gets a benefit of $13,442, and you can see for the Florida resident, again, a little more robust savings than we're seeing here in New Jersey. Now let's look at the business owner. So if you have, say, a business owner that operates their business through a partnership and has income of $1 million, you can see the other metrics there: charitable contribution, $1,000, mortgage interest, real estate taxes, and so on. We haven't gotten into it in detail yet, but let's just assume that this business is eligible for the QBI deduction. We'll discuss that at length a little further on in the webinar. But you can see the significant reduction in taxes comparatively 2018, new tax law, 2017, old tax law, that this business owner is going to benefit from. So looking at a New Jersey resident, we have a single taxpayer saving around $63,000 of taxes, married filing joint just under $80,000 of tax savings, year-over-year comparison, and then the Florida resident, again, seeing a more significant tax benefit than savings year-over-year than we are in New Jersey. And predominantly, too, the other contributing factor is, in the past, as a Florida resident, you didn't get the benefit of your state tax deductions as we did here in New Jersey. So you weren't, the loss of the state tax deduction isn't as impactful as it would be for somebody in a high tax state such as New Jersey. And then the last example illustration that we'll go through, same metrics, but this particular business is not eligible for the QBI deduction, which is that, again, we'll get into it, it's a 20% qualified business income deduction. So you can see the impact year over year, 2017 comparatively to 2018, and how that works out. So, but generally speaking, the theme here that can be illustrated comparatively 2018 to 2017 in these income ranges, you can see there is a tax saving based on the new tax law. There is a reduction in overall federal taxes. In my experience, what we're seeing with our clients and our more, in our ultra high net worth clients that are earning, say 10, 20, 30, 40, $50 million a year, that savings is not as impactful at those income levels because of the loss of their itemized deductions. Kind of neutralizes the impact of the lower rates. So with that, I just want to illustrate the change in the tax brackets. For the table you have in front of you here is for single taxpayers. The top row illustrates the 2018 income tax brackets comparatively to the 2017 tax brackets, which are on the line there below. So you can see up to, for single taxpayers, up to about $200,000 of income. The brackets are kind of aligned between 2018 and 17, except for 18 the rates are a little lower. Then you can see as you get over 200,000, interestingly, with the single taxpayers in 2018, the 35%, the addition of a new 35% bracket kicks in where the old 33% bracket. So subject to a higher tax at a lower income level, but as you can see with the new tax rate brackets in 18 under the new law, there's been a significant expansion of the brackets at the higher income levels. So 35% applies all the way up to just about 500,000 of income before we hit the maximum rate of 37%, where under prior law you hit the maximum rate of 39.6 at just about 420,000. So same illustration here for married taxpayers filing joint. Again, at the lower brackets, you kind of see an alignment there between the thresholds. Again, 2018, taxpayers seeing lower rates. And then interesting, you can see where you kick in just about 350,000 at that 32%, and then just under 400,000, you hit the 35% bracket, which is kind of aligns with where we did in 17. And again, an expansion of that bracket. So married taxpayers not hitting that maximum 37% rate until about 600,000 of income, where previously it was about 475,000. You hit the maximum 39.6. So that benefit in the reduction of the rates and the expansion of the brackets is why we're seeing lower overall tax bills in 2018. So with respect to the mortgage and home equity interest limitations, there's been some changes there. I know, apologize for this slide. There's a lot of information here. Not going to go through it in too much detail. I think the big takeaways here I'd like everybody to walk away with, in looking at qualified residence interest, your home mortgage interest, if you had debt for acquisition indebtedness on your principal residence that you incurred before December 15th, 2017, that debt is grandfathered in. And that's kind of a concept that not everybody's grasping. So what I mean by grandfathered in, you still can deduct that interest on mortgage indebtedness up to $1 million. So any new debt for new acquisition indebtedness after December 15, 2017, the limitation is now $750,000. So the point there is the old debt still qualifies for the $1 million limit. The other point to note is on the home equity indebtedness. Pre-tax law changes, you were able to deduct up to $100,000, up to interest on $100,000 of home equity interest, and it didn't matter what you used that $100,000 for. You could have used it for a shopping spree at the mall. That'd be a very expensive shopping spree, but you could do that and deduct up to $100,000 of home equity indebtedness. 2018, under the new tax law, that interest is no longer deductible. However, you can still, the tracing rules still apply under the home equity rules. So if you took out a home equity loan and you use that money to fund your business operations, then you can deduct that interest against your business income. If you used it to make investments in the market, in the stock market, you can deduct that interest as investment interest expense. So you can recharacterize the interest from home equity interest to another category. And then acquisition indebtedness still does qualify. So after, in 2018 going forward, if you take out a home equity loan and you put an addition on your house, that interest is still deductible up to the $100,000. Okay, so now on to some of the business provisions that I think a lot of the growth stage companies here would be very interested in hearing about. The first thing we'll talk about is the excess business loss limitation. This is a completely new provision, something that we haven't dealt with previously. So as a business owner, and particularly structured as a flow-through, so I'm either an LLC or an S-Corp, a partnership, the income flowing through to me on my individual return, historically under the old tax law, and it still applies under the new tax law, we had three hurdles we had to get over. We had to have basis in our pass-through entity. With that basis, we had to be at risk, and then we had to materially participate, so we had the passive activity rules. These are well-established rules. We've had to deal with these for a long time now, but there's a new hurdle, a fourth hurdle that we have to get over, which is the limitation on excess business losses. So this excess business loss applies to all non-corporate taxpayers. The excess business loss cannot be deducted in the year the loss is incurred, and any amounts disallowed as a loss, as an excess loss, will carry over to the following year and interestingly be converted to a net operating loss. So kind of a complicated provision. So let's look at what the definition of an excess business loss is. It's the aggregate of deductions attributable to taxpayers' trade or business over the sum of your adjusted gross income from all trade or businesses, plus $250,000 for single, $500,000 for married filing joint. Complicated definition. To simplify it, let's assume if I aggregate all my trades or businesses and I have an overall loss of $700,000, that loss that I can deduct currently, assuming I have basis, I'm at risk, and I'm materially participate, I got through the first three hurdles. The fourth hurdle says that $700,000 loss, I can only take $500,000 of it. $200,000 carries forward. So typically in the past, where maybe you can, have the zero tax liability in that year, if you have other income, you may wind up actually paying tax. And we'll show an illustration to kind of walk through this. So the excess business loss limitation applies to tax years beginning after December 31st, 17 and before January 1st, 2026. So again, this is one of those sunset provisions that is set to expire. The thresholds amount that I indicated there for $250,000 and $500,000 married filing joint are indexed annually for inflation, so those will increase slightly each year. And then these limitations are applied at the partner and shareholder levels. So here's a quick example. Taxpayers filing a joint return and has flow-through items of income or loss. You have $450,000 in wages, $250,000 in investment income, and a loss on a real estate partnership of $800,000. So historically, before the tax law changes, that would all net to $100,000 loss for adjusted gross income purposes. So let's see what that looks like under the new tax law. We have our $800,000 loss. We aggregate our income and then apply the loss limitation. So in this particular case, our excess business loss is $300,000 because as we indicated in the case of a married taxpayer filing a joint return, that $800,000 loss is limited, resulting in $300,000 of a loss carry forward to the following year, which converts again to a net operating loss. So in this case, the taxpayer in 2018, comparatively to 2017, winds up with adjusted gross income of $200,000, where in 17 I had a $100,000 loss. So in a situation where I previously would wind up at a loss, in 18 I'm now going to pay tax. So not necessarily one of the favorable provisions, and these are one of the pay-fors in terms of being able for Congress to be able to lower individual rates. There were some things that we had to give back on, and this is one of them. Another area where we had to give back is with respect to net operating losses. There were some significant changes in the carry forward and utilization. So this table here just illustrates and compares the old tax law to the new tax law with respect to net operating losses. Again, if I'm a business owner in a pass-through entity, and that entity, S corporation or LLC, kicks a loss off to me, and in the following years converted to a net operating loss because I couldn't take it in the current year and have income to offset it against. Under the new law, well, first let's start under the old law. If in 2018 I have an NOL carries forward to 19, historically there wouldn't be any limitation on utilizing that NOL. Under the new law, the net operating loss is limited to 80% of taxable income. So for, let's just say, in 2018, I have an overall loss. My taxable income is negative. So that creates a net operating loss, which I carry forward to 2019. So let's just say for illustrative purposes, I have a $2 million loss. Let's use that number. That's going to carry forward to 19. Now in 19, I turn things around, right the ship with my business. We're profitable. I now have $1 million of income in 2019. Under old law, I would be able to take my $2 million NOL for regular tax purposes and completely eliminate that $1 million of income in 2018. Now under the new law, I can only take 80% of taxable income in 2019. So if I have $1 million in income, I can only take $800,000 of that and offset it with the $2 million NOL. So again, in a situation where typically, historically I would have a loss situation, I'm now wind up paying tax. With respect to carrybacks, those have been eliminated. So in 2018, if I incur an NOL, I can't carry that back to prior years where I was profitable, as I could under the old law. I could carry that back for 2 years. And then in terms of carry forwards under the new law, I can carry those losses forward indefinitely, where under old law we had a 20-year shelf life when the losses would expire. So significant changes there to the net operating loss rules. One thing to point out here and a note, which is of significance for sure, these new net operating loss rules take in effect for losses that are created after 12/31/2017. So what that requires taxpayers to do is track 2 separate buckets of net operating losses. And what that means is, so any net operating loss that was created in 2017 and prior, those preserve their attributes in being able to offset 100% of income. And then it's only the losses that are incurred after 1/1/2018 that can only offset 80% of income going forward. So it's incumbent upon taxpayers and their tax providers to track those net operating losses separately to 2 different buckets going forward. All right, so let's talk about next Section 199A, which is commonly referred to as the 199A deduction, or the qualified business income deduction. This is a completely new provision. Again, applies to non-corporate taxpayers, so we're looking at businesses structured as LLCs, S-corps, sole proprietors, partnerships, limited partnerships. This provision here was really intended to put these flow-through sole proprietor type operations in parity with C corporations. Under the new law, we'll get to that towards the end of the presentation, C corps now benefit from a 21% flat tax rate. So to allow pass-through entities to be as competitive in terms of federal taxes with C corps, they created this qualified business income deduction. And I'll preface this by saying, we're just going to kind of do a high-level overview, but Congress couldn't have thought of anything more complicated and convoluted than they did to provide that same benefit that C corporations have to pass-through entities. So I'll often refer to the QBI in our presentation, the qualified business income deduction, as QBI, to abbreviate it. It's intended to replace the DPAD, which is the domestic production activities deduction. Some of you may be familiar with that, taking that in the past, which was a 9% deduction. So this is more robust, giving taxpayers a 20% deduction. So this is kind of a repeal and replace scenario, repealing the DPAD and replacing it with this QBI deduction. And what the deduction effectively does is provides a 20% deduction on your business income. So just quick illustrative purposes, assume my business income is $1 million for the year and it qualifies for this deduction, I get 20% of that as a deduction. So I'll get subject to, as we'll get into, certain limitations, but on that $1 million of flow-through business income, I'll get a $200,000 deduction. So since I'm paying tax on 80% of my income, 80% times the maximum rate of 37% results in an effective rate of 29.6. So the QBI deduction, while it is a deduction concept, it doesn't change or provide any beneficial tax rates. It does reduce the top effective rate to 29.6, which is a lot more competitive when you look at the 21% corporate rate. It's still higher than the corporate rate, but at 21% with C Corps, you still have to contend with double tax. So it kind of brings those two different entity types into parity. Some of the key determinations we're going to look at next in assessing whether your business is going to be eligible for the QBI deduction. You got to look at the nature of the business, the type of income, and then there's numerical limitations placed on the deduction amount. So what's a qualified business? It's any trade or business other than a specified service business or the business of being an employee. So if I'm an employee and I just get a W-2 every year, I can't take a 20% QBI deduction against my wage income. Now, what's a specified service business? While this is the QBI deduction is a new tax law, it relied on, to disqualify a business, it relied on an old provision in our tax law to provide a definition of what a specified service business is. And this is right out of the law here. So it's any business involved in performing services in the fields of health, law, engineering, architecture, accounting, actuarial, science, performing arts, consulting, athletics, finance, brokerage, and any trade or business where the principal assets of such trade or business is the reputation or skill of one or more employees. So that's the actual definition of a specified service business. And to reiterate, these types of industries are not eligible for this additional 20% deduction. So you might have noticed there, engineering and architecture, those words were stricken out of the definition there, and that was intentional. So under the new tax law, there's a specific provision that removes architectural and engineering firms from the list of disqualified businesses. In addition to that list of disqualified businesses, they added investing, investment management, trade, dealing in securities, partnership interests, or commodities. So when you look at the 2 bullet points in aggregate, exclusive of the engineering and architectural industries, those are all the businesses that don't qualify for the QBI deduction. Now, when you look at the first bullet point there, with that long definition, there's a couple of things that are problematic there. First is it's a very broad definition. So trying to understand what businesses fall outside the scope of this deduction becomes a challenge. Specifically, when you look at the term there, consulting. Consulting can mean a lot of different things, and right now, this is, in terms of the current law, this is all we have to go on. There's no further explanation of this definition. There are no regulations. There's no guidance. So we're kind of left to interpret what the intent is here until we get further guidance from the government. And then the last point in bullet point number 1 is, the reputation or skill of one or more employees. That would disqualify you. So what does that mean? Certainly very subjective in nature. As a litmus test, I'll just throw out there, if I'm a business owner and I call in sick for the day and don't show up to work, if that business isn't going to generate any revenue because the lack of my presence, probably the reputation or skill of that business is dependent solely on me. So looking at both ends of the spectrum in terms of that definition, just kind of back up to that. On one side, say a manufacturer clearly would qualify. On the other side of the spectrum, somebody that's a lawyer or an accountant, such as myself, not going to qualify. In between, there's a lot of gray area, and still waiting for some guidance in terms of regulations and IRS-issued guidance to better define what businesses would qualify and don't qualify for this deduction. So let's take a look at the type of income that would qualify. Again, shareholders in an S Corp, partners in a partnership, sole proprietorships reporting directly on Schedule C, and owners of rental property reporting directly on Schedule E. So what is qualified business income? Basically, all income from your trade or business. It does not include interest, dividends, cap gains, and foreign income. So income that's not effectively connected with a U.S. trade or business. And then let's talk about some numerical limitations. So in that illustrative example that I threw out there a few slides ago, if I have $1 million of income from my trade or business, my initial deduction that I'd qualify for would be $200,000. So the first numerical limitation is that $200,000 deduction is limited to 50% of wages with respect to the trade or business. So that $1 million of income that I generated, let's just assume for illustrative purposes that that business doesn't have a lot of human capital. So I don't have a lot of employees, a lot of W-2 wages. So let's say I have one employee I pay $100,000 to. So that's going to impose a limitation on that $200,000 deduction. It's going to limit it to $100,000. Now the second bullet point there is an alternative limitation. I can reduce that 50% of wage limitation to 25% and then add to it 2.5% the unadjusted basis of qualified property. Again, not very simple in terms of calculations and compliance. And what this second limitation, this alternative limitation, is aimed at is the real estate industry. So looking at the first 50% of wage limitation, if I'm a commercial landlord and I have a commercial office building, typically I don't have any wages. I don't have a lot of employees. Typically I'll have a management company that manages the property for me, and that management company has the employees and pays the wages. So that's problematic for me as a landlord. If I don't have any wages, I can't take this QBI deduction, and clearly the intent for the law was to benefit real estate enterprises as well. So kind of at the last minute, Congress added this other provision. So let's assume I'm a landlord, and the original cost basis of my property is, say, $10 million. So if I take 2.5% of $10 million, that's $250,000. I can add that to 25% of the wages I pay. Let's assume a zero in this case. So on that $1 million of income, I have $200,000 deduction. My limit is $250,000, so I can get the $200,000 deduction. So that's kind of at a high level how that works. And then overall limitation, the deduction can't exceed the 20% of your taxable income. So if your taxable income is lower than your qualified business income, you're going to be limited again. So we'll take a walk through a quick example here. 2018, A is a married taxpayer, has $100,000 of qualified business income, $100,000 of long-term cap gains, $30,000 of deductions, resulting in taxable income of $170,000. So the $199 deduction for A is limited to the lesser of $20,000, which is 20% times $100,000 of the QBI income, or $14,000, 20% of the $70,000, which is the excess taxable income over net capital gains of $100,000. So in looking at the qualified business income deduction, there's some key issues to consider in terms of planning and strategizing to maximize this benefit for your business in 2018 and going forward. So mixed service businesses are particularly problematic, and as of yet, we don't have a lot of guidance from the original, from the Tax Cut and Job Act in terms of how we're going to treat mixed service businesses. So let's say I'm a manufacturer and 80% of my revenue is from manufacturing, and then the balance, 20% of my revenue is, say, from process consulting. And we learned in that previous slide in the definition of a service business, consulting is disqualified. So I have 20% of my revenue disqualified from QBI deduction. So does that 20% taint the other 80%, or is there going to be a bifurcation? It kind of remains to be seen. So we're looking at talking to clients about concepts like packing and cracking. So cracking would be splitting those business enterprises into two separate entities, having the consulting arm being a separate entity and the manufacturing arm being in a separate entity to ensure that the manufacturing business gets the benefit of this 20% deduction. Again, if conversely packing is putting multiple businesses together to achieve a structure where majority of my business or all of my business income is going to be in those areas that are not specified service business. Looking at tiered structures, so if I have multiple layers of LLCs, And along the chain, there's business income that qualifies and doesn't qualify. We don't understand, and there's not enough guidance in the current law as it stands on how the business income is going to flow through the various tiers to the ultimate taxpayer to determine the eligibility and the amount of the deduction. As I indicated, service businesses are certainly a gray area. And then state complications. For Florida residents, probably not a complication, but for other taxpayers located in taxing states, at the federal level, you're going to get a 20% deduction. The complexities there, how does that impact the state tax liability? Does the state conform with the federal? Do they decouple? So forth. All right, so the next provision that we'll look at is the business interest limitation. So again, these are all kind of, this is one of those pay-for provisions. There's certain things in the Tax Cut and Job Act that are beneficial to taxpayers, and there's certain areas where we're going to lose deductions and expenses to help pay for the reduction in the rates. So looking at the business interest limitation for tax years after 17, net interest expense is only deductible to the extent of 30% of adjusted taxable income. Doesn't include investment interest. Doesn't apply to any businesses with average receipts of less than $25 million. So this typically applies to, this limitation applies to the larger taxpayers. Excess interest expense is carried forward indefinitely and doesn't apply to real estate trades or businesses. So another win for the real estate industry here. Those highly leveraged real estate businesses will be able to deduct their interest as long as they elect to use a different depreciation method. And doesn't apply, there's a specific provision in carve-out for car dealerships that have floor plan interest. So their floor plan interest is fully deductible and not limited here. So a quick example to illustrate the limitation here. Corporation X has $50,000 of adjusted taxable income, $20,000 of business interest income, and $2,000 of business interest income, and $20,000 of business interest expense. So the limitation here, we take our $500,000 of adjusted taxable income times 30% is $15,000. We add our interest income, which provides a limitation of $17,000. So the $20,000 of business interest expense that we had is limited to $17,000, and we have an excess amount of $3,000. So that $3,000 carries forward indefinitely to the next year and forward. So next, let's talk about depreciation. There's a lot of benefits and enhancements in deductions, in deducting capital expenditures under the new tax law. I provided some tables to illustrate a comparison of the old tax law versus the new. Kind of a lot of information. We're not going to go through a lot of the nuances in detail here. I just wanted to highlight and point out for you the more notable and more beneficial provisions under the new depreciation deduction. So the Section 179 deduction, which is an election that's been on the books in the tax law for a long time now, the amount has been changing every year. But that's set now at $1 million for tax years beginning after December 31st, 2017, and indexed for inflation for years beginning in 2019. The phase-out thresholds are still there. Again, this is kind of something that's been in the law previously. It's just the limitation that's been increased. One thing notable with Section 179 deduction, they expanded the definition of qualified property. So typically in the past, the Section 179 deduction could be made for machinery and equipment, furniture and fixtures, those types of improvements. Typically long-term improvements, buildings, structural elements of the building didn't qualify for 179, but now there are certain aspects of a building that does. So for example, if you put a new roof on, new HVAC system, new fire protection or alarm system, or a security system, historically those types of improvements had to be depreciated in a commercial property over 39 years. Now those can be expensed up to $1 million limit in the year the improvement is placed in service. Now let's talk about bonus depreciation. Again, this is a concept that's been on the books since the era of the Bush tax cuts. Looking at this provision here actually was retroactively effective as of September 27, 2017. So bonus depreciation in 2017 under the old law was limited at 50% of the original cost can be expensed in a year that the property is placed in service. As of September 27th through December 31st, 2022, you can expense 100% of that qualifying property. And then in 2023, going forward through 2026, you can see there's a phase out. So from 100,000 down to 20,000. And then no bonus in 2017 and forward unless there is some legislative changes to make that either permanent or extended. And then another significant provision with respect to bonus that came out of the new tax law is historically bonus depreciation, that 100% expensing, only applied to new property. So if you went out and you bought a new piece of equipment, a new forklift, new fixtures, it had to be brand new. In other words, you had to be the original owner in order to take 100% of that deduction. Under the new tax law, it can be used property as well. So you don't have to be the original owner. So if you buy a piece of used equipment, you can deduct that. And I think the intent here was really to kind of stimulate, provide some incentive to the mergers and acquisition market. This is going to really help stimulate growth in that area and allow companies, private equity firms, strategic buyers to go out and buy assets of a company and get a better write-off than they did in the past because they are used assets. So let's quickly talk about accounting methods. Again, looking comparatively old law versus new law, I'll try to summarize this for you very, very simply here. Under the old law, there were certain restrictions on the use of the cash method basis of accounting, on the UNICAP rules for accounting for inventory, and percentage of completion on long-term contracts. So if taxpayers exceeded a specific revenue threshold, so for a C Corp that had gross receipts of $5 million or greater for the prior 3 years, prior 3-year average, was forced to use accrual basis accounting. That threshold was raised to $25 million. For taxpayers that account for inventory, typically in the past, if you were a producer, there's different rules with producers and resellers, but if you were a producer, it didn't matter what your income threshold was. If you produced property, you were subject to the UNICAP rules and have to account for various overhead, direct and indirect expenses in valuing your inventory at the end of the year. The new tax law places a $25 million gross receipts threshold. So if my average gross receipts for the prior 3 years don't exceed $25 million, even if I'm a producer, I'm not subject to the UNICAP rules. So that's a significant benefit for a lot of the smaller producers out there in the U.S. Being able to simplify their compliance and not have that increase in taxable income that typically arises when you apply the UNICAP rules. And then with long-term contracts, same thing. Historically, if I had $10 million of average gross receipts for the prior 3 years, I was forced, if I'm a contractor, I was forced to use percentage of completion versus a cash basis or completed contract method. So now that there's a significant increase in that limitation, up to $25 million of gross receipts, I can enjoy utilizing the cash basis or completed contract method. So now, just want to jump into some C Corp provisions and kind of talk a little bit about C Corp versus pass-through structures and give everybody a little insight into the current thought process there. So looking at some of the corporate changes in the Tax Cut and Job Act, just on a highlight basis. Not going to get too deep into these, and some of them are pretty self-explanatory. But for C corps, there's a 21% corporate tax rate. Now that 21% corporate tax rate is down from the top marginal rate of 35%. So a significant reduction for U.S. taxpayers that are structured as C corporations. Now that 21% rate, in and of itself, if you look at that comparatively to the 37% maximum individual rate, or if we get the qualified business income deduction, our 29.6% rate, that 21% rate sounds very attractive. So we've had a lot of our clients calling us since the new tax law was enacted at the end of 2017 saying, hey, I'm currently a pass-through entity. I'm an S-Corp. I'm a partnership. I'm an LLC. I want to convert, should I convert to a C Corp and be able to enjoy the 21% tax rate? Pay lower taxes. Why should I pay 29.6 or 37% maximum when I can pay 21% federal? So it's a good question, and it's something that needs to be explored by each and every business. But and I'll get into that in a little more detail to kind of explain the analysis to you. But under the just going further through the corporate highlights here, alternative minimum tax was repealed for corporations. It's still in effect for individuals. As I indicated earlier, there's been a repeal of the domestic production activities deduction. For C corps, we still have the same limit on business interest and NOLs. There's a provision for R&D expense amortization. Beginning in 2022, R&D expenses can't be deducted in full. They need to be amortized over 5 years. And then there's been a significant overhaul in the international tax regime. Typically, just to kind of summarize that, looking at it at a high level, historically the U.S. tax system kind of worked as in a worldwide system, meaning any U.S. resident business would pay tax in the U.S. on their worldwide income. There's been a shift to more of a territorial system where you pay tax in the foreign jurisdiction where you earn the income, and not tax it in the U.S. So, and that's the way most foreign jurisdictions work. So the international overhaul was really intended to make U.S.-based companies and allow them to be more competitive in the global marketplace. And for this shift in this worldwide system to a territorial system, there was a one-time deemed repatriation or toll charge, which I'm sure a lot of you heard about in the media. As of the end of 2017, any U.S.-based company that had profits parked overseas were forced to pay tax in the U.S. on those profits. So let's look at, again, just a quick comparison of top federal rates. Top of the chart shows C corps. You can see there's a 14% reduction in the top rate on individuals, slight reduction in the top marginal rate at 2.6%. For wage earners, capital gain rate, dividend rate stayed the same, and in interest, rents, and royalties, slight reduction in rates. And in business owners, assuming that the QBI deduction is available, experience a 10% rate reduction. So again, just highlighting the winner here in terms of the greatest reduction in tax rates is the C corporation. So again, begs the question, should I convert my pass-through business to a C corp? While that's really an in-depth analysis and you have to look at a lot of different considerations, both tax and non-tax, this table kind of illustrates and compares the C corp rate to that of an S corporation and a partnership. So the first column heading there under no, and then the second one yes. No assumes that business doesn't qualify for the 20% QBI deduction. Yes obviously assumes they do. So a C corporation that doesn't make any distributions to its shareholder owners obviously pays a 21% corporate tax rate. Now the thing, even though there's a favorable 21% corporate tax rate, C corps are still have that concept of double taxation, versus the single layer of tax, that a pass-through pays. So assuming that a C corp distributes 100% of its after-tax profits, its annual earnings, to its owners in the form of a dividend, you're going to pay the 21% corporate tax rate first, and then the individual dividend rate of 23.8%. So you can see the double tax rate on a C Corp that distributes 100% of its profits every year to its shareholders is going to pay 44.8%. If you compare that to an S Corp that doesn't get the QBI deduction, they're going to pay a maximum rate on the same income, just different entity, just different corporate solution, you're going to pay 37%. And if you get the 20% QBI deduction, you're going to pay 29.6%. So you can see there, and then looking at partnerships, partnerships have a slightly higher tax rate than S Corps because partnership income is generally subject to self-employment tax. But you can see there in all situations, the pass-through entity is still favorable comparatively to the double taxation of the corporate rate. Now, depending, that statement I just made is assuming that 100% of the distributions from the corporation are paid out in the form of dividends. So somewhere in between 100% distributions and no distributions, it may make sense. If you're, and we'll kind of show some, let's just jump to that now. So when might a C Corp make sense? So if you're a growth stage company that needs to reinvest earnings into the business and not distribute those out to shareholders, it may make sense for you to be a C Corp. If you need to, if you have a desire to simplify your structure and you have investors and they don't like getting K-1s and paying estimates and things like that. So that would help broaden your investor base. If you're a specified service business and you're as a pass-through, you're not eligible for the QBI, you may want to consider being a C Corp. But you also have to look at exit strategy, whether it's stock sale, gift, or hold until death, versus an asset sale. Certain industries have minimum capital requirements, can't take out distributions. Again, that might make sense to be a C Corp. And then there's some state tax savings that can be generated through the C Corp for companies that sell tangible personal property. So let's see. Just kind of trying to manage the clock here. I know we're almost out of time and want to get to everybody's questions. This is the last slide I have for today. The summary of C Corp versus pass-through. There's multiple data points to consider, very fact-specific. We're analyzing this for a lot of our clients. There's no one-size-fits-all answer for everybody, and we have to kind of look at what they expect current earnings and future earnings to look like, what the exit strategy is, and also look at non-tax considerations. So with that, we'll open it up to questions. Tammy, I know you've been monitoring these as they come in. If we can't get to them all in the time permitted here, I'll try to get back to you by email after.
Absolutely. And yes, we will be sending out this recorded webinar to everybody who is on the call, as well as the PowerPoint presentation and contact information for Dave. So be looking for that as soon as with the webinar here. To ask a few questions to you, and if you have any other questions, to post them in the incident. And we have one. It says, if I incur an NOL in 2017, can that still be carried back?
Yes, sure. So NOL, reference to a net operating loss. So those laws under the Tax Cut and Job Act eliminated the carryback provision for net operating losses occurred in 2018 going forward. But if you incur a loss in 2017, that can still be carried back to carried back 2 years to 2016 and 15 to recapture taxes paid in those years.
And another question is, what happens to business interest that is limited from being deducted in the current year?
Okay, that's a good question. So business interest in excess of the 30% taxable income limitation carries forward indefinitely to the next year and is treated as interest paid in that year. So you would add your carry forward interest to the current interest expense and recompute your limitation every year. Anything else, Tammy?
One more. Can I deduct inventory costs in full if my business has less than $25 million of gross revenue, of gross receipts? Sorry.
Okay, another good question. So can I deduct my inventory costs in full? Yeah, so as I indicated, you know, in 2018, under the Tax Cut and Job Act, a business that's a producer or even a reseller that's under $25 million in average annual gross receipts doesn't have to account for UNICAP. UNICAP is a provision in the tax law that requires you to burden your, when valuing your ending inventory, add additional overhead costs, indirect operating costs to the value of your inventory. So the new tax law alleviates the need to do that, but you do have to still account for your inventory. You can't expense it in full. So you just have to account for your inventory at cost under your normal cost accounting method. You just don't have to put in a lot of the indirect labor and overhead burdens.
I also think that the other key point that we work with are S corps. They're not C corps. They're LLCs and S corps. And I think that the point that you are making of decisions of whether or not there's going to be the surgence, of C corps, that people that are going from that S corp to the C corp. What can you just? I know we're at our limit here from a time standpoint, but is there anything else on that point? Because I think that could impact a lot of our second stage businesses, because I see a lot of them that are not C corps at this point in time.
Right. It's a decision that has to be thought through. There's no rush to do it immediately. We're getting a lot of uneasiness with our clients, feeling like they're missing some sort of opportunity if they don't convert to a C corp. I would just recommend that you talk to your service provider about it. If you want to talk to me about it, more than happy to do that, and just kind of understand the pros and cons. Understand what the tax savings would be or cost on current earnings as if the C corp, and then on exit. There could be some detrimental tax implications when you sell. When you look at your strategic plan, and if you're in terms of your exit strategy, if you're looking at a 5 or 10 year window to sell your business as a C corp, that could be it could have very negative impacts on your tax liability versus the pass-through structure that you're converting from. It could be a lot more efficient to sell a pass-through business than a C corp. So you can't just look at the 21% rate and say that's a savings for me. You have to consider the sale and exit of the business and what that looks like. So just you kind of think it through. We developed a model where we can kind of model out different scenarios and variables to illustrate what the cost savings or additional tax would be, and then also have to talk to other business advisors to understand the implications of change in corporate solution. Talk to your attorney, talk to your insurance broker, talk to your banker. There may be other implications there that just beyond the change in tax.
Very good. Well, David, thank you so much for the information today. I think it was really jam-packed with lots of great advice and analysis of the tax laws, and we appreciate you and we appreciate Withum for being a sponsor today. And thank you, everybody, for joining us. We have lots of great opportunities with lots of our partners around the state that are helping to provide webinars. Our next one will be in July, so keep your email open for the announcement for our next webinar, which will take place second Wednesday in July. So thank you for joining us today. Again, thank you, David, for this webinar today. It was really appreciated, and thank you to Withum.